Hello everybody, I'm delighted to be with you this Saturday morning to talk about the responsibilities of directors of companies listed on the Hong Kong Stock Exchange. I'll be looking at directors' obligations in terms of the obligations of listed companies when they issue new shares and the listing rules requirements for connected transactions. That's a pretty dense set of rules, so it'll be quite heavy going. I'll also be looking at the SFC Statement on the disclosure of actual controllers or beneficial owners of counterparties to a transaction, and the exchange's ESG guide in the context of recent changes. The obligations of directors of companies listed on the main board and GEM are virtually the same in the context of directors' duties. So as I've mentioned before, although I'll be referring to main board rules, much of what I say about the obligations of directors of main board companies also applies to the directors of GEM listed companies. So firstly, issues of new securities, pre-emption rights. One of the principles of the listing rules is to ensure the equal treatment of all shareholders. A key aspect of this is ensuring that members' shareholdings are not unfairly diluted by the issue of new shares to third parties. Under Rule 727B, a listco can't undertake a rights issue, open offer or specific mandate placing, whether individually or aggregated within a 12-month period, that would result in a dilution effect of 25% or more. There's an exemption from this requirement in exceptional circumstances. For example, where the listed company submits to the exchange and the exchange accepts this, that the company's in financial difficulties and the proposed capital raise is needed to rescue it. The exemption, however, doesn't apply to open offers. Also, Rule 1336(1) says that except in the case of a pro rata offer to existing shareholders, the directors of a listed company have to obtain the consent of shareholders in general meeting prior to the allotment, issue or grant of shares, securities, convertible into shares or options, warrants or similar rights for any convertible securities. Alternatively, Rule 1336(2)B allows a general mandate to be obtained from shareholders at a general meeting to issue shares, convertible securities or rights to acquire shares. The general mandate must be subject to a restriction that the maximum number of securities which can be allotted can't exceed 20% of the number of the company's issued shares as at the date of the resolution granting the general mandate. If a share consolidation or subdivision is carried out after the approval of the issue mandate and general meeting, the maximum number of securities that can be issued will be adjusted accordingly. The general mandate can also separately authorize the company to issue shares equivalent to the number of shares repurchased since the date of the mandate, up to a maximum of 10% of the number of the company's issued shares as at the date of the resolution granting the repurchase mandate. A general mandate granted under these rules will lapse at the end of the next AGM unless it's renewed by ordinary resolution passed at that AGM. General mandates can also be revoked or varied by ordinary resolution of the shareholders in general meeting. The initial conversion price of convertible securities issued under Rule 1336(2)B must not be lower than the benchmarked price of the shares at the time of the placing. The listed company can't issue warrants, options, or other rights to subscribe for new shares, that's convertible securities into new shares, for cash consideration pursuant to a general mandate. The restrictions in Rule 1336 don't apply to pro rata offers unless they're an open offer, provided that the pro rata offer is made to all existing shareholders, excluding shareholders resident in a place outside Hong Kong, which the directors, after making inquiries as to the legal restrictions under the relevant laws of such place and the requirements of the relevant body or stock exchange, consider it necessary or expedient to exclude because of any relevant restrictions or requirements. An example would be where a foreign jurisdiction required a listco to prepare a separate form of offering document in compliance with local laws. However, if shareholders resident in another jurisdiction are excluded from the pro rata offer, the circular offer document must contain an explanation regarding the exclusion of these shareholders and must be delivered to shareholders who are excluded from the offer, subject to compliance with relevant law and regulation. In view of the listing rule restrictions, notices of AGMs generally include a resolution granting a general mandate to the directors to issue shares other than on a pro rata basis, up to the permitted maximum amount, that's 20% of the number of issued shares, plus a number equivalent to the number of shares repurchased, subject to a cap of 10%, of the number of issued shares at the date of the repurchase mandate. Listed companies can also call an EGM to approve an issue of shares for a specific purpose. A company which has obtained a general mandate may also refresh the general mandate at any time before the next AGM. However, the company's controlling shareholders, that's anyone that holds 30% or more, and their associates, or if there aren't any controlling shareholders, the company's directors, other than the INEDs and chief executive and their associates, are not allowed to vote in favour of the refreshment. In addition, the circular to shareholders relating to the proposed renewing of the general mandate must set out the company's history of refreshments of the mandate since the last AGM, the amount of proceeds raised from the use of the general mandate, the use of the proceeds raised, and fourthly, the intended use of any amount not yet used, and how the listed company has dealt with that amount. Examples of what a listed company might use the funds raised by a new share issue under a general mandate for include expansion through acquiring another company in the same business or acquiring new premises or machinery. These restrictions were introduced mainly because of abuse of the repeated refreshment of the 20% mandate. The restrictions in Rule 1336 apply equally to listed companies incorporated in Hong Kong and overseas. They don't, however, apply to overseas listed companies whose primary listing is on another stock exchange, which isn't subject to any other statutory or other requirement giving shareholders preemptive rights over further issues of shares. A listed company isn't allowed to issue or enter into any agreement to issue any further shares or securities convertible into its shares within 6 months of the start of dealing in its shares on the exchange. Exceptions to this exist for an issue of shares whose listing has been approved by the exchange under a share option scheme under Chapter 17 of the listing rules, the exercise of conversion rights attaching to warrants issued as part of an IPO, any capitalization issue, capital reduction or consolidation or subdivision of shares, and the issue of shares or securities under an agreement entered into before the commencement of dealing, the material terms of which were disclosed in the listing document issued on the IPO. Where a company's directors agree to issue securities for cash, whether under a general mandate or not, the company must publish an announcement as soon as possible and no later than 30 minutes before the start of the morning trading session on the next day or any pre-opening session. The announcement must contain the information set out in Rule 1328, and the information the announcement is required to contain includes the number, class, and aggregate nominal value of the shares which the company has agreed to issue. If the company is going to issue securities that are convertible into its shares, for example, convertible bonds or options or warrants to subscribe for its shares or convertible securities, the announcement should also contain the conversion or subscription price and certain other specified information and the maximum number of shares that could be issued on exercise of the conversion or subscription rights. Announcements of a new share issue for cash must also set out the total funds to be raised and the proposed use of the proceeds, the share issue price and how this was determined, the reasons for the share issue. The names of the people to whom the shares will be allotted must be included if there are less than 6 of them, and if there's more than 6, then a generic description of the people can be given. The announcement must also say whether the shares are issued under a general mandate and give details of the mandate. In the case of a placing or open offer of securities for cash consideration under the company's general mandate, the issue must not be at a discount of 20% or more to the benchmark price of the securities. For this purpose, the benchmark price is the higher of the closing price on the date of the relevant placing agreement or other agreement involving the proposed issue of shares under the general mandate, and the average closing price in the 5 trading days immediately before the earlier of the date of the announcement of the placing or the proposed transaction or arrangement involving the proposed issue of shares under the general mandate, or the earlier of that or the date of the placing agreement or other agreement involving the proposed issue of shares under the general mandate, and the date on which the placing or subscription price is finally fixed. As I've already mentioned, the exception to this rule is where the company can satisfy the exchange that it's in a serious financial position and that the only way it can be saved is by an urgent rescue operation involving the issue of new securities at a price which is at a discount of 20% or more to the security's benchmark price, or that there are other exceptional circumstances. Where shares are issued for cash under a general mandate at a discount of 20% or more, the company has to publish an announcement giving details of the allottees no later than the start of trading on the next business day after the agreement is signed. If there are less than 10 allottees, the announcement must include the name of each allottee or its beneficial owner and confirmation of their independence from the listco. If there's more than 10, the name of each allottee subscribing for 5% or more of the shares has to be stated, and there can be a general description of the other allottees together with a confirmation of their independence from the listco. In calculating the 5% limit, the number of securities subscribed by the allottee, its holding company and their subsidiaries have to be aggregated. I'm now going to talk about the very detailed requirements for connected transactions entered into by listed companies. These are set out in Chapter 14A of the Main Board Listing Rules. The rules on connected transactions are extensive and, in my view, probably among the most detailed and stringent connected transaction rules of any exchange worldwide. The exchange's objectives under the connected transactions rules are to ensure that listcos take into account the interests of their shareholders as a whole when they or one of their subsidiaries enters into a connected transaction, and to provide safeguards against directors or chief executives or substantial shareholders or their associates taking advantage of their positions to the detriment of the independent shareholders. This is achieved by the general requirement of independent shareholder approval for some connected transactions. Connected transactions include certain transactions entered into between a listed company and its connected persons or their associates. So I'm going to begin by looking at the definitions of transaction, connected person, and associate. I'll also go through certain other types of transaction which are connected transactions, even when no connected party is directly involved. I'll then look at the announcement, shareholder approval, and reporting requirements for connected transactions, and at the categories of connected transactions that are exempt from all or some of these requirements. I'll also go through certain additional requirements that apply to continuing connected transactions. So, first of all, generally, connected transactions are transactions between a listed company or any of its subsidiaries on the one hand and a connected person or their associate on the other. For classification purposes, the exchange can aggregate a series of transactions that are completed over a 12-month period or are otherwise related. The factors which the exchange takes into account in determining whether connected transactions should be aggregated or whether they're entered into by the listed company with the same party or parties who are connected with one another, and whether they involve the acquisition or disposal of securities or interests in a company or group of companies, whether they involve the acquisition or disposal of parts of one asset, or whether they would together lead to the listed company becoming substantially involved in a business activity that wasn't previously part of its principal business activities. The exchange may also aggregate all continuing connected transactions with a single connected person. A connected transaction can also be a notifiable transaction, and if so, the listed company has to comply with both Chapter 14 and all the notifiable transaction rules which I talked about yesterday, and at the same time comply with 14A of the listing rules relating to connected transactions. So first of all, the term transaction. So for the purposes of the connected transaction requirements, it includes a long list of suggestions that are included in the definition, and these are regardless of whether the transaction is of a revenue nature and entered into in the ordinary and usual course of the group's business. The list isn't exhaustive, as the wording of the listing rules says that the term transactions includes these. So the first is the acquisition or disposal of assets, buying or selling assets, including a deemed disposal. A deemed disposal is an allotment of shares by a subsidiary of the listed company, which results in a reduction in the listed company's percentage interest in the subsidiary's shares. So the listco's interest in the subsidiary is diluted. Any transaction involving an option to acquire or dispose of assets or to subscribe for securities, for example, an option given to a third party to acquire shares in the listco, entering into or terminating finance or operating leases, granting an indemnity or a guarantee or providing financial assistance. This would include providing a loan to a connected person or guaranteeing a loan that a bank has made to a listed company's connected person. Entering into a joint venture in any form, for example, setting up a joint venture company with a third party to conduct a new business. Issuing new securities of the listed company or its subsidiaries, including underwriting or sub-underwriting an issue of securities. The provision, receipt or sharing of services, most frequently administrative or secretarial services. Providing or acquiring raw materials, intermediate products and finished goods. A qualified property acquisition. So turning now to the definition of connected person. Well, connected persons are defined to include a director, chief executive or substantial shareholder, that's someone who holds 10% or more of the voting rights of a listed company, or any of its subsidiaries or an associate of any of these people. People connected with the listed company's insignificant subsidiaries are not connected persons, and an insignificant subsidiary is defined as a subsidiary of the listco whose total assets, profits and revenue compared to that of the listco are less than 10% under the percentage ratios under Chapter 14 for each of the 3 preceding financial years, or 5% under those Chapter 14 percentage ratios for the latest financial year. A person who was a director of the listed company or any of its subsidiaries in the past 12 months and an associate of any such person. So someone who's a director remains a connected person for 12 months after they cease to be a director. A supervisor of a PLC listed company or any of its subsidiaries and an associate of any such person, or a connected subsidiary. And a connected subsidiary is defined as a non-wholly owned subsidiary of the listco, where any connected person at the listco level is entitled to exercise or control the voting of 10% or more of that company. This excludes an indirect interest in the subsidiary, which is held by the connected person through the listco, or a subsidiary of such a non-wholly owned subsidiary. I should mention, for the avoidance of doubt, that a wholly owned subsidiary of a listed company is not counted as a connected person. So in this diagram, Company A and Company C are connected persons of the listed company, as Company A is a non-wholly owned subsidiary, in which a connected person at the listed company level, Director B, holds 10% of the shares. Company C, as its subsidiary, is also connected. Who are the associates of an individual? The associates of a connected person who's an individual, whether a director or a substantial shareholder, include their spouse, their or their spouse's child or stepchild, natural or adopted, under the age of 18, and they're called immediate family members. The trustees acting in their capacity as trustees of any trust of which the individual or their immediate family member is a beneficiary, or in the case of a discretionary trust, is, to their knowledge, a discretionary object. The trustees of an employee share scheme or occupational pension scheme are not associates of a connected person if the scheme is established for a wide scope of participants and the connected person's interests in the scheme are together less than 30%. A company in which the individual, their immediate family members and/or trustees control the exercise of 30% or more of the voting power or control the composition of a majority of the board of directors and any subsidiary of such company. A company controlled as to 30% by a person who's not an associate of that person if the interests of the person and their associates in the company are together less than 10%. In the diagrams on the slide, neither Company A nor Company B is an associate of individual X because individual X's direct interest is less than 10%. Carrying on with the definition of associates for individuals. Also, a person cohabiting with an individual as a spouse or their child, stepchild, parent, step-parent, sibling or step-sibling. This is referred to as a group as family members. A company in which the family members, individually or together, or the family members together with the individual, their immediate family members, that was the other definition you'll remember, and or the trustees control the exercise of 50% or more of the voting power or control the composition of a majority of the board of directors and any of its subsidiaries. A parent-in-law, brother-in-law, sister-in-law, son-in-law, daughter-in-law, grandparent, grandchild, uncle, aunt, nephew, niece, or cousin of the connected person, whose association with the connected person is such that, in the opinion of the exchange, the proposed transaction should be subject to the connected transaction requirements. An example of where the exchange decided that a transaction was connected because it deemed one of these parties to be a deemed connected person involved Grand Ocean Advanced Resources. Two wholly owned subsidiaries of the listco agreed to sell their shares in another company. The purchaser in the transaction was owned as to 90% by a cousin of an individual who had been a director of the listco in the 12 months preceding the announcement of the share sale. The purchaser was deemed to be a connected person. And a company in which the relatives, or the relatives together with the connected person, the trustees, their immediate family members, and or family members control the exercise of 50% or more of the voting power or control the composition of a majority of the board of directors and any of its subsidiaries, whose association with the connected person is such that, in the opinion of the exchange, the proposed transaction should be subject to the connected transaction requirements. So who are the associates of a company? The associates of a connected person, which is a company, include its subsidiary or holding company or fellow subsidiary of such a holding company, the trustees of any trust of which the company is a beneficiary, or to the company's knowledge, discretionary object. Any company in which the company, the group companies, and or the trustees can exercise or control the exercise of more than 30% of the votes of the listco, or control the composition of the majority of the board of directors and any subsidiary of that company. So who are deemed connected persons? The exchange has the power to deem a person or entity as a listed company's connected person, where the person or entity has entered or proposes to enter into a transaction with the listed group, and any agreement, arrangement, understanding, or undertaking, whether formal, informal, express, or implied, with respect to the transaction with a director, chief executive, or substantial shareholder of the listco, or any of its subsidiaries, or a person who was a director within the previous 12 months. And the person or entity should, in the exchange's opinion, be considered as a connected person. Where a listed company acquires an interest in a company from a third party who is not a connected person, the transaction may be a connected person transaction under Rule 14A28 if a substantial shareholder of the target company is or is proposed to be a controller, that's a director, chief executive, or controlling shareholder of the listco, or is or will, as a result of the transaction, become an associate of a controller or proposed controller of the listco. Acquiring the target company's assets will also be a connected transaction if the transaction accounts for 90% or more of the target company's net assets or total assets. The exchange can aggregate the interests of the controller and their associates in the target company to determine if they are together the target company's substantial shareholder. Rule 14A28 doesn't apply to a listed company's acquisition if the controller or their associates are together a substantial shareholder of the target only because of their indirect shareholdings in the target through the listed company's group. Financial assistance. This is defined to include granting credit, lending money, providing an indemnity against loan obligations, or providing security for or guaranteeing a loan. Financial assistance provided by a listed company or its subsidiaries will be a connected transaction where it's provided to a connected person or a commonly held entity as defined, and likewise financial assistance provided to a listco or its subsidiaries will be a connected transaction where it's provided by a connected person or a commonly held entity. The term commonly held entity refers to Rule 14A27. Options involving connected persons. The grant, acceptance, transfer, exercise, termination, or non-exercise of an option by a listco or its subsidiaries to or from a connected person is a connected transaction and is classified by reference to the percentage ratios which I talked about earlier. Termination of an option by a listed company is not a transaction if it's made under the terms of the original agreement and the listco has no discretion in relation to the termination. Options granted by a listco to a connected person. If the listed company's group grants an option to a connected person and exercise of the option is not at the group's discretion, on grant of the option to the connected person, the transaction is classified as if the option had already been exercised. The percentage ratios are calculated based on the consideration for the transaction, which is taken to include the premium and the exercise price, the value of the underlying assets, and the revenue attributable to the assets. The listco has to announce any exercise or transfer of the option by the option holder, and/or if the option is not exercised in full, the option holder notifying the listco's group that it will not exercise the option or the expiry of the option, whichever is the earlier. So what about options acquired by a listed group from a connected person? If a listed group acquires or accepts an option granted by a connected person where the option is exercisable at the discretion of the listed group, for example, if a director grants an option to the listco to buy a business that the director owns, then on acquisition by the group, only the premium is taken for the purpose of calculating the percentage ratios. However, if the premium represents 10% or more of the sum of the premium and the exercise price, the percentage ratios are calculated based on the premium, the exercise price, the value of the underlying assets, and the revenue attributable to the assets. On exercise of the option by the group, the exercise price, the value of the underlying assets, and the revenue attributable to them are used for the purpose of calculating the percentage ratios. If the listed group transfers the option to a third party, or it terminates the option, or decides not to exercise the option, the transaction is classified as if the option was exercised. So the exercise price, value of the underlying assets, revenue attributable, and, if applicable, the consideration for transferring the option or the amount received or payable by the listed group for terminating the option are used for the purpose of the percentage ratios. The exchange may allow a listed company to classify the transaction using the asset and consideration ratios based on the higher of. For a put option held by the listco's group, the exercise price less the value of the assets subject to the option, or for a call option held by the listco's group, the value of the assets subject to the option less the exercise price, and the consideration or amount payable or receivable by the listed group. A listed company may adopt the second alternative classification test I just mentioned if the value of the option assets is readily ascertainable and the listco is able to provide a valuation of the option assets prepared by an independent valuer using generally accepted methodologies and a confirmation from the listco's INEDs and an IFA that the transfer, termination or non-exercise of the option is fair and reasonable and in the interests of the listco and its shareholders as a whole. If a listco adopts the alternative method, it has to announce the transfer, termination or non-exercise of the option with the views of the INEDs and the IFA. Joint ventures involving connected persons. The entering into of any arrangement or agreement involving a joint venture entity being formed in any form, such as a partnership or a company or any other form of joint venture arrangement by a listco and a connected person, will be a connected transaction. Looking now at continuing connected transactions. These are connected transactions that involve the provision of goods, services or financial assistance and are carried out on a continuing or recurring basis and are expected to extend over a period of time. They are often transactions carried out in a group's ordinary and usual course of business, and overseas investors looking at the Hong Kong market sometimes find it difficult to understand why arm's length transactions on normal commercial terms are also treated in our market as connected transactions in some cases, and this is an example. So connected and continuing connected transactions fall into three categories. Firstly, non-exempt transactions. These have to be reported in the listed company's annual report, announced on the website of the exchange and the listco, and made conditional on being approved by the listed company's independent shareholders. Secondly, transactions which are exempt from the reporting announcement and independent shareholder approval requirements. These are wholly exempt transactions. Nothing needs to be done. And thirdly, transactions which are partially exempt They are exempt only from the circular independent financial advice and shareholder approval requirements, but they are subject to reporting and announcement requirements. So directors should take care to ensure that a listed company has adequate and effective internal controls in place to identify and deal with connected and continuing connected transactions under the listing rules. According to the Exchange's guidance for board and directors issued in July 2018, an effective risk management and internal control system is important not only as it ensures regulatory compliance, but is also linked to greater financial performance. The board has the responsibility of risk identification and control. Formally documented risk management policy and procedures should be in place and endorsed by the board and senior management. There should be testing of the effectiveness of systems, including performing walkthroughs for notifiable and connected transactions. Based on the findings, any weaknesses should be fixed. Directors of a listco are collectively and individually responsible for ensuring that the listco complies fully with the connected transaction requirements under the listing rules. And as you know, and we've talked about, directors are subject to disciplinary proceedings for failure to discharge their duties and responsibilities, and they can't use as a defence the fact that they didn't receive sufficient information from the company or that they didn't understand the transactions. There's a requirement for written agreements. The listed company must enter a written agreement with all relevant parties in respect of a connected transaction. Reporting requirements. The listed company's next published annual report and accounts must include details of the connected transaction, including the transaction date, the transaction parties, and a description of their connected relationship, a brief description of the transaction and its purpose, the total consideration and terms, and the nature and extent of the connected person's interest. There's announcement requirements. The listco must announce a connected transaction as soon as practicable after its terms have been agreed. The announcement has to contain the information required to be included in announcements of notifiable transactions under Rules 1458 to 1460. For example, a description of the listed company's principal business and the counterparty's identity and description of their principal business activities, the consideration how it was determined. The announcement must also set out the information required to be included in announcements of connected transactions by Rule 14A68. Including the identities and a description of the principal business activities of the ultimate beneficial owners of the parties to the transaction, the connected relationship between the parties, and their interests in the transaction. Shareholder approval requirements. Connected transactions and continuing connected transactions must in some cases be approved by the listed company's independent shareholders. Any shareholder who has a material interest in the transaction has to abstain from voting. Voting on the resolution approving the transaction must of course be by way of poll. In relation to a connected transaction, the board has to establish an independent board committee to advise shareholders as to whether the terms of any connected transaction are fair and reasonable, whether the transaction is in the interests of the listco and the shareholders as a whole, whether the connected transactions are normal commercial terms or better, and in the listco's ordinary and usual course of business, and how to vote, taking into consideration the views of the independent financial advisor. An IFA acceptable to the exchange must be appointed to make recommendations to the independent board committee and shareholders as to the matters I've just referred to. Where there's a chairman of the independent board committee, it's expected that they are available to answer questions at any general meeting to approve a connected transaction. In some cases, the exchange can waive the general meeting requirement and accept written shareholders' approval if no shareholder of the listco would be required to abstain from voting if a general meeting were held, and written shareholders' approval is obtained from a shareholder or closely allied group of shareholders who together hold more than 50% of the voting rights in general meeting. The listed company has to send a circular to shareholders in relation to a connected transaction at the same time as it gives notice of the general meeting to approve the transaction, or if the transaction is to be approved by way of written shareholders' approval from a shareholder or closely allied group of shareholders within 15 business days after publication of the announcement. The shareholder circular must comply with the contents requirements of Rules 14A69 and 14A70 and must include a letter from the Independent Board Committee and the IFA opinion. Continuing connected transactions. There are additional requirements for continuing connected transactions. An agreement governing a continuing connected transaction must be on normal commercial terms and must be for a fixed period, which can't exceed 3 years, except in special circumstances where the nature of the transaction requires a longer period. In this case, the listed company must appoint an IFA to explain why the agreement requires a longer period, and that is, it's normal business practice for agreements of this type to be of a longer duration. The reporting requirements must be followed for each subsequent financial year during which the listco undertakes the continuing connected transaction. The listco has to set out a maximum aggregate annual cap expressed in monetary terms, the basis of which has to be disclosed. The annual cap must be determined by reference to previous transactions and figures in the group's published information, or be based on reasonable assumptions if no previous transaction exists. The annual cap must be approved by shareholders if the continuing connected transaction requires shareholder approval. If the annual cap is exceeded, or if the relevant agreement is renewed, or its terms are changed materially, the listco must re-comply with the announcement and independent shareholder approval requirements. Each year, the INEDs of the listco must review the continuing connected transactions and confirm in the annual report and accounts that the transactions have been entered into in the ordinary and usual course of business of the group and on normal commercial terms or better, and in accordance with the relevant agreement on terms that are fair, reasonable, and in the interests of the listco's shareholders as a whole. Each year, the auditors have to provide a letter to the listco's board confirming whether anything has come to their attention that causes them to believe that the non-exempt continuing connected transactions haven't been approved by the board, were not in all material respects in accordance with the group's pricing policies if the transactions involve the group's provision of goods or services, weren't entered into in all material respects in accordance with the relevant agreement, and have exceeded the annual cap. The listco must provide the exchange with a copy of this auditor's letter at least 10 business days before the bulk print of the annual report. Exemptions. Connected transactions exempt from the reporting announcement and independent shareholder approval requirements include intra-group transactions within the group, de minimis transactions, certain issues of new securities, purchases of own securities, directors' service contracts, providing directors' indemnity insurance or buying directors' insurance, sharing of administrative services, buying or selling of consumer goods or services, transactions with associates of a passive investor, transactions with a connected person at the subsidiary level, transactions between a listco and a non-wholly owned subsidiary, or between its non-wholly owned subsidiaries are wholly exempt, where none of the subsidiaries concerned are connected persons, and no connected persons at the listco level exercise or control the exercise of 10% or more of the voting power at any general meeting of the subsidiaries concerned. Connected transactions are also exempt from the listing rule requirements, whether between the listco's non-wholly owned subsidiary, of which a connected person of the listco controls 10% or more of the voting power at any general meeting of such non-wholly owned subsidiary, and any of its subsidiaries which are connected persons only because they are subsidiaries of this non-wholly owned subsidiary, or where the transaction is between any of these subsidiaries. So on this slide, you can see X is a connected person at the issuer level and has a 10% or more shareholding in subsidiary A. Subsidiary A is a connected subsidiary. Subsidiaries B and C are subsidiaries of subsidiary A. Subsidiaries B and C are also connected subsidiaries. So transactions between the listco or subsidiary D with subsidiaries A, B, or C are connected transactions. Transactions between any of the subsidiaries A, B, and C are not connected if subsidiaries B and C are connected only because of their relationship with subsidiary A. De minimis transactions. Transactions on normal commercial terms are wholly exempt, where each or all of the percentage ratio except the profits ratio is less than 0.1%, or less than 1% and the transaction's connected only because it involves a connected person at the subsidiary level, or is less than 5% and the total consideration is less than 3 million Hong Kong dollars. This exemption doesn't apply to the issue of new securities by a listed company to a connected person. Issues of new securities by a listco or its subsidiaries to a connected person are wholly exempt where the connected person receives a pro rata entitlement to securities in their capacity as shareholder. Or securities are issued to a connected person under a share options scheme which complies with Chapter 17, or are issued under a share option scheme in existence before the listed company was listed on the exchange for which approval for listing was granted at the time of listing. Or a connected person subscribes for securities in a rights issue or open offer through excess application. Or securities are issued under a top-up placing and subscription. This is a commonly used structure which allows for quicker delivery of shares in the market and usually uses a structure where the new shares are issued to the connected person after the connected person has reduced their holding in the same class of shares by placing them to third parties to facilitate delivery who are not its associates under a placing agreement and within 14 days after the date of the placing agreement. And the number of new shares issued to the connected person doesn't exceed the number of shares placed by the connected person. The new shares are issued at a price not less than the placing price, and the placing price can be adjusted for the expenses of the placing. Repurchase of shares by a listco. Share repurchases by a listco or its subsidiary from a connected person on the exchange or a recognised stock exchange are wholly exempt from the connected transaction requirements unless the connected person knowingly sells shares to the listco. Share repurchases under a general offer made under the Code on Share Buybacks are also wholly exempt. Directors' service contracts. A director entering into a service contract with the listco or its subsidiary is wholly exempt. The provision of an indemnity to or the purchase of insurance for a director of a listco or its subsidiaries is exempt under the connected transaction rules if the indemnity or insurance is for liabilities that may be incurred in the course of the director performing their duties, and the indemnity or insurance is in a form allowed under the laws of Hong Kong, and where the company providing or purchasing the insurance is incorporated outside Hong Kong, the laws of the company's place of incorporation. The sharing of administrative services between a group and a connected person on a cost basis is wholly exempt, provided that the costs are identifiable and are allocated to the parties involved on a fair and reasonable basis. Buying or selling consumer goods or services. A listed group buying consumer goods or services as a customer from or selling consumer goods or services to a connected person on normal commercial terms or better in its ordinary and usual course of business is wholly exempt if certain conditions are met. The goods or services must be of a type ordinarily supplied for private use or consumption. They must be for the buyer's own consumption or use and not be processed into the buyer's products or for resale or used by the buyer for any of its businesses or contemplated businesses. This condition doesn't apply if the buyer is the group and there's an open market and transparency in the pricing of the goods or services. The goods or services must be consumed by the buyer in the same state as when they were bought, and the transaction must be on no more favourable terms to the connected person or no less favourable terms to the listed group than those available to or from independent third parties. So, for example, if a listco owns a chain of coffee shops and a director buys and pays for a takeaway coffee and drinks it, that would be an exempt connected transaction. Transactions with associates of a passive investor. A connected transaction of a revenue nature in the ordinary and usual course of the listed group's business and on normal commercial terms or better is wholly exempt, where the transaction is a connected transaction only because it involves an associate of a substantial shareholder of the listco or of any of its subsidiaries, and the substantial shareholder is a passive investor in the listco and meets certain criteria. Either it's a sovereign fund or a unit trust or mutual fund authorised by the SFC or an overseas authority. It has a wide spread of investments other than the shares of the listed company's group and the relevant associate. It is a connected person only because it's a substantial shareholder of the listco. It's not a controlling shareholder of the listco or its subsidiaries. It doesn't have any representative on the board of directors of the listco and is not involved in the management of the group, although that could include any influence over the listed company's management through negative control, for example, veto rights, on material matters relevant to the listed company's group. And it's independent from the directors, chief executive, controlling shareholders and any other substantial shareholders of the listco or its subsidiaries. Turning now to partially exempt connected transactions. De minimis transactions. Connected transactions, other than an issue of new shares by a listed company, are exempt from the circular, IFA and independent shareholder approval requirements, but are subject to reporting and announcement requirements where the connected transactions are normal commercial terms or better, or the percentage ratios except the profits ratio are less than 5%, or less than 25%, and the total consideration is less than 10 million Hong Kong dollars. For continuing connected transactions, the assets, revenue and consideration ratios must be calculated using the cap as the numerator. Transactions with people connected only at the subsidiary level are exempt from the circular IFA and shareholder approval requirements if the transactions are on normal commercial terms or better, they're approved by the company's board of directors, and the company's INEDs confirm that the terms of the transactions are fair and reasonable and they're on normal commercial terms and in the interests of the company and their shareholders as a whole. There are certain exemptions for connected transactions which also apply to continuing connected transactions. These are the sharing of administrative services, buying or selling consumer goods or services, transactions with associates of a passive investor, and de minimis transactions. In the case of the de minimis exemption, the percentage ratios are calculated on an annual basis. Wholly exempt continuing connected transactions are exempt from the reporting, announcement, independent shareholder approval and annual review requirements. Financial assistance provided by a listco or its subsidiary to a connected person or a commonly held entity, which, as you'll remember, is a company whose shareholders include a shareholder of the listco's group and a connected person at the listco level who control the exercise of 10% or more of the listco's voting shares, is fully exempt if it's provided on normal commercial terms or better to the group, and the assistance provided is in proportion to the equity interest directly held by the company or its subsidiary in the connected person or commonly held entity, and any guarantee relating to this is given on a several basis. Financial assistance provided by a listed company for the benefit of a connected person or commonly held entity is exempt from the shareholders' approval circular and IFA requirements if it's on normal commercial terms or better, and each of the percentage ratios except the profits ratio are less than 5% or less than 25%, and the total value of the financial assistance plus any monetary advantage to the connected person or commonly held entity is less than 10 million Hong Kong dollars. Financial assistance provided by a connected person or commonly held entity to a listco is fully exempt, again on normal commercial terms or better to the group, and there's no security over the assets of the listco or its subsidiaries granted in respect of the financial assistance. In any situation, however, the exchange reserves the right to specify that an exemption won't apply to a particular transaction or to require a listco to meet the independent shareholders' approval requirements. Turning now to a related issue, the SFC issued a statement on disclosure of actual controllers of beneficial owners of counterparties to a transaction in November last year. The statement reminds Hong Kong listcos of the need to properly disclose the identities of counterparties to corporate transactions and announcements, shareholders' circulars and other documents relating to the transaction. In its statement, the SFC notes that where listed companies acquire or dispose of interests in target companies, or they form joint ventures with a target or inject capital into a business, the identities of the actual controllers of the counterparties may be important information for shareholders and must be disclosed. The SFC said that circular or meaningless definitions of counterparties must be avoided, and the names of the controllers and beneficial owners of the entities consummating the transaction have to be disclosed. This information may only be left out if the listco is reasonably satisfied that the disclosure of the actual controllers or beneficial owners isn't necessary for the investing public to make an informed assessment of the companies and its activities. The SFC emphasised in the statement that if their identity is required for an informed assessment, non-disclosure may mean that the document in question contains materially incomplete information. In serious cases, the SFC have said that they will intervene using their powers under the Securities and Futures Stock Market Listing Rules, such as by directing the suspension of trading in the company's shares. Turning now to environmental and social governance and the most recent changes. Now, this is not a subject which all listed companies in Hong Kong have been extremely keen to embrace. Despite Hong Kong's role as one of the world's leading financial markets, certainly on some of the data I've seen, Hong Kong lags behind in terms of ESG investing. Of course, that's from the investor side, but I think it also reflects the lack of enthusiasm, perhaps, for some Hong Kong listed companies on ESG reporting and embedding ESG throughout their organizations. For example, there was 2016 data from Global Sustainable Investment Review, which showed that Europe and the US were the biggest worldwide contributors in terms of ESG investment. They accounted for 52.6% and 38.1% of global ESG investment. Although Hong Kong was one of the largest markets in Asia, ex-Japan, accounting for 26% of regional assets, its share was only 0.06% of global ESG investments. Companies listed on the Hong Kong Exchange are, of course, required to publish an annual report on environmental, social and governance issues, ESG, for each financial year, either in their annual reports or in a separate ESG document. However, progress in Hong Kong listed company ESG reporting has been somewhat uneven. The Hong Kong Exchange has reported that despite a high level of compliance and some companies providing excellent information, other companies adopt a box-ticking approach to disclosure. Comments have also been made that Hong Kong listed companies provide limited disclosure of the board's involvement in ESG issues, the company's ESG strategy and long-term ESG goals and how these will be achieved. The requirements for publishing ESG reports are set out in Listing Rule 1391, and there are two levels of disclosure. They have to disclose the information required under mandatory disclosure requirements. These are in Part B of Appendix 27 to the rules, and say whether the company's complied with the so-called comply or explain provisions of Part C of Appendix 27, and give considered reasons for any deviation. Failure to comply with the ESG disclosure requirements is a breach of the listing rules. Under recent listing rule amendments, ESG reports which are not published as part of an annual report have to be published within 5 months after the financial year end for both main board and GEM companies. The Exchange also encourages companies to publish separate ESG reports at the same time as they publish their annual reports. Under the listing rule amendments, companies are not required to provide printed ESG reports to shareholders except in response to specific requests. Listcos must, however, notify shareholders about the publication of a separate ESG report on the Exchange and the company's website. The revised listing rules and ESG guide are effective for financial years beginning on or after the 1st of July this year. There are two main subject areas to the ESG reporting regime, environmental and social, and each has various aspects. Each aspect sets out general disclosures and key performance indicators for companies to report on how they are performed. In addition to the comply or explain provisions, companies are encouraged to identify and disclose additional ESG factors and KPIs, including recommended disclosures that reflect significant environmental and social impact or matters that have a substantial influence on stakeholders' assessments and decisions. Companies are expected to engage with their stakeholders on an ongoing basis to understand their views and facilitate ways of meeting their expectations. The ESG guide set out in Appendix 27 of the rules isn't comprehensive, and companies can refer to any international ESG reporting guide applicable to their industry, which can be adopted as long as it contains comparable disclosure provisions to Appendix 27's comply or explain provisions. Overall responsibility for a listed company's ESG reporting lies with its board of directors, who must evaluate and determine the listed company's ESG-related risks and ensure that an effective ESG risk management system is in place. A listed company's management is required to provide a confirmation to the board as to the system's effectiveness. The Exchange's recent revisions to the ESG guide clarify that companies must follow all 4 reporting principles in preparing their ESG report and have to disclose how they've applied the reporting principles in the ESG report. This requirement will apply to 3 of the 4 reporting principles. These are materiality, quantitative, and consistency principles. And the 4th principle, the balance principle, the Exchange thinks should be evident from the ESG report itself. So firstly, the materiality principle. The company's board has ultimate responsibility for determining the materiality of ESG factors, and the company has to disclose its process for identifying and selecting criteria for material ESG factors, and if stakeholder engagement is conducted, a description of the significant stakeholders identified and the process and results of the company's stakeholder engagement. This could cover, for example, customers, suppliers, etc. The company should also indicate whether any comply or explain provisions are not disclosed because they're not considered material for the company, and explain how the company arrived at that determination. Previously, there wasn't a strict requirement for this to be disclosed. The reason for this is it's now required is that the exchange's review of ESG disclosure found that while 2/3 of companies disclosed having undertaken an assessment, the amount of detail given as to how it was performed varied, and less than 1/3 of ESG reports disclosed the criteria adopted in selecting materiality ESG factors. There are two types of materiality assessment, internal and external. So the internal materiality assessment, senior managers and key employees should conduct an internal materiality assessment. Since the listco staff should have a better understanding than external parties of the company's business and circumstances, they should in theory be in the best position to identify the material ESG factors for the company. The exchange discourages the outsourcing of companies' internal materiality assessments. The factors to be taken into account in performing the internal materiality assessment are the company's overall mission and competitive strategy, corporate values, policies, strategies, operational management systems, impact assessments, goals and targets, including its risk assessment framework, risk register, and related studies and analyses. Laws, regulations, internal agreements or voluntary agreements of strategic significance to the company, and main topics and future challenges for the company's sector, particularly taking into account relevant guidance and resources. External materiality assessment. A listco should engage with its stakeholders in identifying and developing accountable and strategic responses to ESG factors. It's therefore important for listcos to build successful relationships with stakeholders and engage with them on an ongoing basis. For these purposes, stakeholders are the entities or individuals that can reasonably be expected to be significantly affected by the company's activities, products and services. For example, students at a college would be stakeholders, whose actions can reasonably be expected to affect the ability of a company to successfully implement their strategies and achieve their objectives. The exchange suggests that a materiality matrix is a useful tool to graphically present the materiality assessment of different ESG factors. A company should identify the material ESG factors and decide the appropriate place of each ESG factor on this matrix. Of course, it's not actually a requirement to use the materiality matrix. So the matrix on this slide shows how the position of each ESG factor on the materiality matrix represents the board's view of its importance to the company. General disclosures, KPIs, and ESG factors that are positioned in quadrant 1 of the materiality matrix are highly material and so of critical importance and should be disclosed in the ESG report. ESG factors that are in a high position on one axis but a low position on the other, i.e. quadrants 2 and 4, may also be considered material, but that would depend. A useful resource for guidance on materiality is the updated version of the exchange's step-by-step guide to ESG reporting, How to Prepare an ESG Report, which is available on the exchange's website. For ESG factors that the board determines to be material and in relation to the comply or explain provisions, the company should either disclose the required information or give considered reasons in the ESG report for not disclosing the information. Next, the quantitative principle. The company is required to disclose information on the standards, methodologies, assumptions and/or calculation tools used, and the source of conversion factors used for the reporting of emissions, energy consumption where applicable, in order to improve transparency and increase shareholders' understanding of ESG data. The exchange has also clarified that targets may be expressed by way of directional statements or quantitative descriptions in order to provide flexibility to companies, and there are examples in the step-by-step guide to ESG reporting. The exchange also encourages companies to refer to or adopt international ESG reporting standards or guidelines relevant to their industries or sectors. Listcos can also refer to Series 18 of the exchange's FAQs on ESG reporting, which compares the provisions of Appendix 27 ESG Guide against a number of international reporting guidelines. Listcos are also required to include a statement in their ESG reports confirming that there's been no change from previous years in the way the ESG report has been prepared. Alternatively, they can describe any changes that may affect meaningful comparison with information provided in previous reports. For example, changes in methodologies or calculation methods. Prior to the 1st of July 2020, there were two levels of disclosure obligations, which were that companies had to state whether or not they've complied with the Comply or Explain provisions of the ESG Guide, and reasons had to be given for any deviation from the Comply or Explain provisions. Companies could choose not to report on the recommended disclosures, which were encouraged but not mandatory. From the 1st of July last month, the two levels of disclosure obligations have become, firstly, mandatory disclosure requirements, and secondly, Comply or Explain provisions. The mandatory disclosure requirements require mandatory disclosure of matters such as board involvement, reporting principles, and materiality assessment. A mandatory disclosure requirement is a statement by the board of the board's oversight of ESG matters, the board's ESG management approach and strategy, and how the board reviews progress made against ESG-related goals and targets. Each company is required to consider its own circumstances in determining the level of disclosure made. The aim of the disclosure requirement is to ensure that listco boards are meaningfully involved in assessing and addressing ESG-related risks. I'll now talk about the provisions of Comply or Explain and the relevant aspects, aspect being a somewhat technical term in this context. There are three environmental aspects of ESG reporting. First of all, emissions. The Comply or Explain provisions require a listco to disclose, among other things, its policies and compliance with relevant law and regulations that have a significant impact on the company in relation to air and greenhouse gas emissions, discharges into water and land, and generation of hazardous and non-hazardous waste. Use of resources. The Comply or Explain provisions require a listco to disclose, among other things, its policies on the efficient use of resources, including energy, water, and other materials. Environmental and natural resources. The Comply or Explain provisions require listcos to disclose policies on minimizing the company's significant impact on the environment and natural resources, and to provide a description of the significant impact of their activities on the environment. That would be pretty obvious for a mining company, perhaps less obvious for a shop, and natural resources and the actions taken to manage them. Climate change. This is a new aspect. The Comply or Explain provisions require companies to disclose their policies on identification and mitigation of significant climate-related issues which have impacted and those which may impact the company. In terms of social, there are four social aspects of ESG reporting. First, employment. Companies are required to disclose their policies and compliance with relevant law and regulation that have a significant impact on the company in relation to compensation, dismissal, recruitment, promotion, working hours, rest periods, equal opportunity, diversity, anti-discrimination, and other benefits and welfare. Companies are recommended to disclose the composition of their workforce by gender, employment type, age group, and geographical region, as well as employee turnover rate by gender, age group, and geographical region. Health and safety. Companies are required to disclose policies and compliance with relevant law and regulation that have a significant impact on the company in relation to providing a safe working environment and protecting employees from occupational hazards. Companies are recommended to disclose the number and rate of work-related fatalities, lost days due to work injury, and a description of occupational health and safety measures adopted and how they're implemented and monitored. A listed company is required to disclose its policies on improving employees' knowledge skills for discharging duties at work and the training provided to employees. Training refers to vocational training, which may include internal and external courses paid for by the employer. Companies are recommended to disclose a percentage of employees trained by gender and employee category. for example, senior management and middle management, and the average training hours completed per employee by gender and employee category. Labour standards. The comply or explain provisions require listcos to disclose policies and compliance with relevant law and regulation that have a significant impact on the company in relation to preventing child and forced labour. Companies are recommended to disclose a description of the measures they take to review employment practices to avoid child and forced labour and a description of steps taken to eliminate these practices if they're discovered. Operating practices. There are 4 operating practice aspects of ESG reporting. Supply chain management. Companies are required to disclose their policies on managing environmental and social risks of the supply chain. Companies are recommended to disclose the number of suppliers by geographical region and a description of their practices relating to the engagement of suppliers, the number of suppliers where the practices are being implemented, and how they're implemented and monitored. The comply or explain provisions require companies to disclose their policies and compliance with relevant laws and regulations that have a significant impact on the company, relating to health and safety, advertising, labelling and privacy matters with regard to products and services provided and methods of redress. Recommended disclosures include the percentage of total products sold or shipped that were subject to recall for safety and health reasons, the number of products and service-related complaints received and how they're dealt with. The exchange also recommends disclosing a company's practices for observing and protecting IP rights, a description of its quality assurance process and recall procedures, and its consumer data protection and privacy policies and how they're implemented and monitored. Anti-corruption. The comply or explain provisions require companies to disclose policies and compliance with relevant law and regulation that have significant impact on the company relating to bribery, corruption, fraud and money laundering. Companies are recommended to disclose the number of concluded legal cases regarding corrupt practices brought against the company or its employees during the reporting period and the outcomes. Recommended disclosures also include a description of preventative measures and whistleblowing procedures and how they're implemented and monitored. Community investment. Companies are required to disclose their policies on community engagement to understand the needs of communities where the company operates and to ensure their activities take into consideration the interests of relevant communities. Companies are recommended to disclose focus areas of contribution, for example, environmental concerns and labour needs, and the resources contributed to the focus area, for example, money or time. Reasons for non-disclosure. The exchanges emphasise that explanation is not seen by them as a less preferred or secondary option. For instance, if a comply or explain provision isn't material to a company, it may be better for the company to explain that no disclosure is made because the provision isn't material to the company, rather than disclosing irrelevant information. When explaining its reasons for not disclosing required information, there are certain issues that a listco should bear in mind. If the reason for not disclosing the information is that it's not considered to be material, the listco should specify the reasons why the disclosure isn't considered to be material. Where information is not disclosed because of confidentiality, the company should set out the specific confidentiality constraints preventing disclosure. Also, if legal prohibitions prevent the information from being disclosed, these should be described in the ESG report. Finally, where information is not disclosed because it's not available, the listco should describe in its ESG report the specific steps it's taking to obtain the information and its expected time frame for obtaining it. The exchange expects disclosure on policy, compliance with relevant law and regulations that have a significant impact on the company, and KPIs. Policies. The listco should provide a summary of its policies that cover each particular aspect, with links to those that are publicly available, containing relevant information such as date of issue, last review date, range and location of entities covered, people or committees responsible for approval and implementation of the policies, references to international standards, widely recognised initiatives. Generic statements such as "we have an anti-corruption policy" without any further elaboration are not acceptable. Information on compliance with relevant law and regulation that have a significant impact on the listco. A listco should also consider whether there are any laws or regulations in respect of a particular aspect which may have a significant impact on the listco. If so, they should state the relevant law and regulation, disclose the potential impact on the listco, and disclose how the company has ensured compliance with relevant law and regulation. Alternatively, the listco should state that there aren't any laws or regulations that have a significant impact on it. Blanket statements of compliance, such as we've complied with all laws and regulations, or statements of absence of non-compliance, such as we're not in breach of any applicable laws and regulations, should be avoided. Disclosure of certifications awarded by standard-setting organisations such as ISO don't equate to disclosure of compliance with local law and regulation. KPIs. Companies should disclose the information called for under relevant KPIs. All social KPIs are required to be reported on a comply or explain basis for the financial year commencing after last month. The exchange has commented that certain KPIs are often overlooked or disclosed incorrectly. For example, the requirement to disclose the total amount of hazardous waste produced by the listed company for a listed company which doesn't produce significant amounts of hazardous waste. The company nevertheless often discloses immaterial ESG data. The exchange has said that these companies should give an explanation if this sort of KPI isn't material. Listed companies also commonly fail to disclose the total amount of non-hazardous waste they produce or to explain the lack of disclosure. Listcos often fail to disclose the amount of packaging materials they use with reference to unit produced or to explain the absence of this disclosure. As regards the KPI requirement to describe the significant impact of the company's activities on the environment and natural resources and actions taken to manage the impact, the exchange has commented that companies commonly confuse this with a requirement to set out their policies on minimizing the significant impact on the environment. What is required is a statement of the listed company's activities, significant impact on the environment and natural resources, and targeted action to manage that impact. The exchange has also provided a non-exhaustive list of aspects that could be material to companies in different sectors. The materiality of each aspect depends on the listco's industry and business operations and may vary between listcos of the same industry. The exchange encourages companies to conduct their own assessment of materiality. The green dots on this slide represent the aspects which are likely to be material to listcos in a particular industry, and the grey dots present the aspects which are very likely to be material to those companies. So, for example, as you can see, the aspects that are most likely to be material for utilities companies and energies companies are emissions, use of resources, climate change, the environment and natural resources, and health and safety. For healthcare companies, on the other hand, the aspects that are most likely to be material are development and training, product responsibility and anti-corruption. Where independent assurance is obtained, the listco should clearly describe in the ESG report the level, scope and processes adopted for the assurance given. Companies may decide whether to disclose the name of the assurance provider. As the exchange states in its step-by-step guide, the ESG report, in their view, is an opportunity for a listco to demonstrate the resilience and readiness of their business activities in relation to sustainable development. By preparing an ESG report, listed companies should be in a better position to identify both risks and opportunities arising from ESG issues relating to their operations. In the exchange's view, companies should use the opportunity to showcase their ability to look beyond risks and realize opportunities through innovation and value creation. I should mention that in my experience, it's a pretty tall order for newly listed companies, particularly small ones, to suddenly have to comply with all these requirements. And it's interesting that they're not actually requirements for an IPO prospectus, although you never know what might happen in the future. This brings me to the end of this presentation. Thank you for joining. I do hope that you enjoyed the webinar.